Good evening, everybody. Hope everybody's having a good summer evening. We've got a perfect summer evening going on in Pittsburgh right now, about 72 degrees, not a cloud in the sky. Matter of fact, we've got a big picnic going on in the backyard right now. So tonight, this is not going to be a long night. We won't be doing stock questions and answers at the end, but I'll try to hit quite a few of them that most people ask for before we get out of here. What we're going to concentrate on is entry and exit. When do you get into positions and when do you don't? I saw a comment late at night the other night that somebody was commenting that some of the picks recently have not worked out. They've just gone the opposite direction. So I've got two comments about that. Number one is the picks are what we think are the best ones that are going to be occurring the next day if they open correctly. So if you're buying positions without listening to the video, you're going to get yourself nipped not every now and then, but quite often. A lot of the picks are based upon how the market and how the stock opens the next day. Secondly, forgot what secondly was. So that's just great. All I'm drinking is Diet Coke. It'll come to me. Anyways. I'm going to just kind of real quick obviously we're in a downtrend in the markets. I mean, this was a break. Just about a bearish engulfing signal in the NASDAQ. Yeah, secondly, it's right after the firstly. That's right. And we've had one big major change in this uptrend, which is, let me see if I can do this correctly. I mean, this trend channel going to the upside is now broken. So that tells us after whatever amount of months this was, 6 months of a nice steady uptrend, we've now broken that uptrending channel, which means there's a change of investor sentiment, obviously. Now, if it's not a convincing signal that we're not maybe quite a bullish engulfing or bearish engulfing signal, I don't know whether this thing works or not. It closed at 115.318. It opened at 15.315. So 3 points away from being a bearish engulfing signal. But what's more compelling is if you look at the NASDAQ chart, you can definitely see that there was a bearish engulfing signal, followed by a gap down through the T-line, and a gap down through the 50-day moving average. So that basically tells us they've given up the ghost. There's probably going to be some more selling. Now, we're also near the bottom of this trend channel. So if the market's telling us what the market is doing, right now, instead of it being able to break out to the upside, it's telling us at best we're still in this downward trend channel. We could see a pop, or we could see them, because of the with a bearish engulfing signal, gap down. Stochastics not in the oversold area. This tells me that we could have more downside, possibly all the way back down to here, which would correspond with the 200-day moving average. Let's see. All right, so I'm going to come back to this here in a little bit on entry and exit strategy. Some of the other indicators. Apparently, Bernanke's talk the other day didn't throw any bullish sentiment into the bond market. The bonds are still heading down, yields heading up. We have a doji after a big down day. Stochastics not in the oversold area. If they open bonds weaker, there could be another big down day, which apparently crude oil. Top of the trend channel, gap down through the T-line from the oversold or overbought area. Implication is there's still a lot more downside potential. Why? Remember what your best friend is, a doji followed by a gap. That tells us there's probably a good probability they're sending things down further. We saw that in gold. This long downtrending channel, and we're not in the oversold area. Had we been in the oversold area and we saw a gap down, that would tell us one thing. But this gap down tells us a whole completely different story. That this isn't a gap down at the bottom. This is a gap down breakout through the downward, or this resistance level right here. And it's a doji gap down with stochastics not in the oversold area just yet. That means there's probably more pressure on gold heading down. Same with silver. Let's make this bigger again. There's the doji. They couldn't get silver up above the T-line, and bang, they've taken it back down. Also, you can see this has been in a nice steady downtrend. Dollar is picking up strength. Probably a result from them starting to squeeze or stop putting mega bucks out on the market. So let's see, a few other things to look at. It looks like soybeans is breaking down, heading down lower. But wheat and corn were holding up, or kind of in an uptrend. Wheat selling off a little bit here in the aftermarket. And let's see, corn sagging a little bit. Looks like it's hit the top of its trend channel. So let's see, what was I going to say on that? Oh, all right. So here's why we want to know what our signals and patterns look like. What do we have here on cocoa? Cocoa is up, gap down doji, gap down again. Basically, we've got a bearish flutter kicker signal telling us there's probably a lot more downside to this. So if this is your trend channel here, your parallel trend channel takes you down into this area someplace. So I'm just kind of showing you this because as long as we know what each of the signals tell us, we've got a much higher probability of moving in that direction. Coffee did a doji, gap down. Which way are we going right now? We're still in a downtrend. They can't get above the T-line. Now they've done a doji gap down. That tells us there's still more downside. And sugar. What's that type of signal? They almost came up to the 50. Now I've done a kicker signal back below the T-line. That pretty much tells me this is a little J-hook pattern. Get ready for some more downside. Feeders and cattle, they're kind of flat. There's a pennant formation setting up in the feeders, and in the live cattle area, that's also flat. I wouldn't be trading them. Now, I am long lean hog still. As long as it stays up above the T-line, this one looks like a fry pan bottom breakout, a J-hook pattern. The pressure still seems like it should be in the uptrend. That's right, nothing worse than flat cattle. All right, now I'm going to go take a step back again. And for those new folks in here, a lot of my recommendations are buy on a stronger open or sell on a weaker open. And so the definition always is, what is a stronger open? What is a weaker open? My definition of a stronger open is that if we have a bullish signal the next day, what do we want to see? We want to see the bulls are still there. We don't want to see it opening back down here. same scenario. If this is a sell signal, if you're shorting, you want to see weakness. You don't want to see the market opening up here. Why would you buy back UNXL if it's in a dip and not yet pulling back? Why would you buy UNXL if it's in a dip and not yet pulling back? I don't understand that question. Why would you buy UNXL if it's in a dip and not yet pulling back? Why would I buy it? We'll get to that one. Buy on positive trading, yes. So my idea of a positive open is that the next day, if we're buying, we want to see the market relatively flat or at least not opening back down here. Now, yesterday, I forget, the pre-market futures were way down. It was right here. This was the Dow, even on the NASDAQ, which came back and closed right here basically on the T-line. If this was still in an uptrend, what did we really need to see? We needed to see the open positive. Okay, yeah, I don't know how to eliminate those old announcements. Yeah, I don't know how you just make them disappear. I probably should figure that out, shouldn't I? Remove after. Now, let's see. Just remove after 10 minutes, 15 minutes. All right, remove after 60 minutes. Okay. All right, I'll have to figure that out. So yes, yeah, that UNXL didn't apply today. That was a few days ago. All right, the X in the upper box, announcement box. Okay. All right, I'll have to find it. But anyways, all right. So let's continue here. So if we were, what did we need to see today on pre-market futures? Basically, if this was still in an uptrend, we shouldn't come back below the T-line. We should see a positive open. The fact that when we woke up and we saw the pre-market futures were down 140 points, you can pretty well guess which way they're going to open it. So that meant there was a lot of stocks over the last few days that closed right on the T-line. And we're seeing the market open weaker today. What was the first thing you should be doing? If they opened it weaker, you close it out immediately. Now, there's a lot of people out there, I say a lot of people because I know I always do this myself, that the market opens weak, they open this lower, and what are we thinking? Oh, maybe they're going to turn the market right around and take it back up. Boy, I wouldn't want to sell here and have them take it right back without me. I would really look stupid, and I'd feel bad that I sold out at the low, blah, blah, blah. I repeat that because I've done that so many times in my life that but anyways, now we know that if you see a sell signal, which is a doji bearish confirmation, closing right on the T-line, that if this wasn't closed out yesterday, it better have one criteria today, which is if it opens below the T-line or opens lower, which means it's opening below the T-line, close it immediately. Now, will there be times when you close it at a loss and it immediately starts coming back up? Yes, there will be times like that. But remember, we're playing the probabilities. The probabilities are that the Japanese rice traders showed us that these sell signals, and we've discovered the T-line being a very effective trend, trend indicator. But if we see a sell signal and it opens below the T-line, for every time you hold it, hoping that it's going to come right back up, I'm going to bet you dime to donuts there's going to be 30 times. At the end of the day, you're going to say, I wish I had closed out on the open. So it hurts to take that loss right there in the open. But it does two things for you. One, it stops you from taking a bigger loss if that's the probabilities are going to keep going in the direction that the indicators say they are. And number two, you've got money back in your account You're not in the position. So what's your mental attitude? Your mental attitude is that you're still not in the position, watching it go down, saying, boy, do I sell here? Do I sell here? Do I sell here? Boy, if I sell here or if I close out this position, they're going to turn it right around. You don't have that decision-making dilemma anymore. You're out of the position. Now you can see what you should be doing, either with this position or going on to another one. So the reason we want to close out immediately when it says it's time to close out is because, number one, the probability say it's time to close out. And number two, now you've got that money and you've got a fresh outlook on what's going on. You're not sitting in positions that are hampering you as far as making a rational decision of what you should be doing next. Let's see. Oh, all right. So, anyways, let's take a look at a few things that, this is what I call observing the obvious, that if you see a position that has been acting well, that one, we are Never Neverland. Well, suspects. And for example, ABC was acting well. This is coming out of this scoop pattern. But then yesterday, we had this hard sell-off at the end of the day, doing kind of a shooting star doji in the overbought condition. So we have to analyze what is our trend doing, or what is our overall pattern, a scoop pattern. But we also have to analyze what our individual signal is doing in that pattern. And if we've gotten to the point where our criteria says we better watch out, if you see a potential sell signal with stochastics in the overbought condition, the trend, the individual signal may be telling you something's happened to this trend. So obviously with the pre-market futures down 100 and some odd points on the open, and this opening lower after a doji, stochastics curling down, probability say let's close out immediately. What's the worst case scenario? That the market just slams down, it comes down, hits the T-line, starts back up. You can always buy back in if the chart tells you it's time to be coming back in. The problem with quick bailouts and buying in again is that in retirement, yes, you can't do that in retirement accounts, obviously. You have to wait 3 days before you can redo. So all you can do there is at any time that you're trading in your retirement account and you think there's going to be some position changing, is that instead of having 100% of your funds committed, you may only have 85% of your funds committed with a little slush fund that when you sell out one position and go into another position, you're not using the funds that you just sold out to use to buy the new funds. What happened? Gene, you got me there. I don't know what that's referring to. Okay, so so this one, market's down 140 points on the open. This one's opening lower after a doji shooting star type signal in the overbought condition. Take a take your did we lose sound or something? Okay. I was trying to figure out what was. All right. So again, now the reason I'm stating this is kind of common sense evaluation. Today we were recommending, if the market opened up strong, that you wanted to buy BYD. Because BYD came all the way back to a little left-right combo right here on the 50-day moving average, closed right smack dab on the T-line. It told us if they opened this positive, they were bouncing off and heading up. The fact that they opened lower gave you a completely different message. It told you don't want to be buying because the buyers aren't there. Do not buy this position. So this, that was the other point that I was trying to make, is the reason that we try to train people not only to recognize good signals and use some of my signals to kind of educate you on why that signal is, what the thought process is for that being a buy is for additional training, but we also want to train everybody on how to do their own scans, because out of all the scans that I did, or all the positions that I did, that maybe I had 6 or 7 that looked good. I'm just for logistics sake, I could only put out 1 or 2, 3 picks each day, 3, 4 picks each day. If it doesn't work, we'll mention some in the chat room, but you should have your own analysis set up to where you've done your own scans and recognize which patterns could be working. Out of 7 picks that you might have picked that look good for the next day, 6 of them may not be working, but you want to go after the one that is working. So let's see. Let me. ACAD is one that we've been following quite a bit in the chat room. But notice what it's done. It's come back and it closed below the T line today. The stochastic's heading down. So you got to kind of think to yourself, all right, we're closing below the T line. It's not a decisive close, but what are my probabilities right here, right now? Well, we know the market looks like it's still cratering. It closed below the T line, even though it did a doji below the T line. That was the only positive, that it was indecisive. And our stochastics are heading down. That's not putting us in a very positive trading situation. Close out the position. When you don't have more probabilities in your favor, just close out the position. I say just close out the position. Your probabilities right now say 2 things can happen bad. 1, at best, it could go flat, or 2, they could open this lower and continue to take it down. The third one is they could take it back up and show that it's kind of bouncing off the T line. However, with 2 out of those 3 bad, close out the position. If it opens positive tomorrow and starts trading positive, you can always buy it back. You're buying back at a higher price, but you're buying back in a situation that tells you the probabilities now are in your favor that things are going back up. Would you short it then? Not necessarily, because we're not seeing there's too many other. Just because something is now not a buy doesn't necessarily mean it's a short. We want to find charts that are much more susceptible to shorting, which we'll get to. Having been unable to react until now, what do we do in case it opens negative again tomorrow? Close out long positions that are in bad shape. Would you short if it opens down? Which one? And remember, you got to put the signal. Remember the 15-minute chart right now on this stock. Whoops, 5-minute, 10-minute. Has absolutely nothing to do with what's going to happen tomorrow on the daily chart. Remember, this is the investor sentiment that occurred in the last 15 minutes of the day. When this stock opens tomorrow, which is 12 hours later, whatever, 16 hours later, the investor sentiment could be completely different. So don't let a intraday chart from the previous day influence what you're doing the next day, unless the markets are not moving too much from where they closed the night before, or if everything's kind of trading where it was trading the night before. If this market opens down another 100 points tomorrow, or the pre-market futures are down another 100 points tomorrow, that chart has absolutely nothing to what's going on with what the investor sentiment is right at this moment. Would you consider it had relative strength compared to AY? You still have to go. It had good strength, but it's still not doesn't matter whether it has good or strength or not. If it has good strength going down better than the market, it's still going down. You want to be out of it. It could open as a doji sandwich tomorrow. But now we're overanalyzing this stock. I mean, we're going to get to some here that look a lot better. Now, there are stocks that have the relative strength built into it. For example, CLWR, is it still going up after hours? Why was this still a good chart? Because it was a fry pan bottom. As we've seen many times before, when the markets are crashing, you can still see patterns that are still working because the information built into investor sentiment building this pattern probably has nothing to do with what the general market is doing. There's something going on here that everybody is buying the stock for some reason, despite the fact the market's going down. So you don't need to have a relative strength indicator showing you that this had relatively good strength compared to what the market was doing. What's that you say? Everything except the daily close is just noise? Yes. However, let me go back to the Dow. If you can see that the daily noise is going slowly this way, that's where you go back to your 10-minute chart and say, all right, what is my market doing? This is where we're looking for it to kind of bottom out and head back up. This is where we're looking for it to kind of bottom out and head back up. But as you can see on the 10-minute chart, there wasn't really any time other than this 30 or 40 minutes that the market came back up above the T-line, and it did it very indecisively and then still continued down. So if you're looking at the chart right here, anticipating that they're going to bounce it back up, and they start failing it and start taking it back down through that support level, that tells you there's more downside, which is exactly what was being told by us from this signal and them opening lower, but there's probably more downside. Okay, Clearwater being a buyout candidate, all right. Let's see. And there's a war on Clearwater, all right. Let's see, all right, let me zip through here. Relative strength, GME. Gapped up today. There's something going on there that has nothing to do with what the market in general is doing. RPRX held up well today, despite what the market is doing. Here's that big fry pan bottom. Something's going on here. So why are we pointing out the ones that have good charts to it? Because if the market is down 300 points today, and there's stocks moving up, the nice thing with candlestick analysis is we can see what patterns are creating those stocks to go up. So if you wanted to go against the flow, meaning you still wanted to own long positions even though the market's going down, we've got the capabilities. It may only be 6 stocks in the whole market that are going up. But doing the scans, you're going to find those 6 stocks, and more than likely, like in the Clearwater chart, something's there that's much stronger than what the market in general is telling us. You can make your assessment fairly easily. There's a fry pan bottom that's breaking out in a market that's down 200 points, 300 points, whatever. NTWK, there's that slow curve. That slow curve usually has something building up. That one still is a viable buy, even if this market is trading lower tomorrow, provided it opens higher tomorrow. CLNT, nothing fantastic here, except you've got the potential of a little flutter kicker signal setting up, and we know what the results of a flutter kicker signal is. If they open positive, they're going positive. If they open positive, they're coming up through the T-line and probably trading higher. If they're trading higher, they're breaking this downward trend channel. Despite what the market's doing, if a flutter kicker is setting up in this, it tells you there's very strong buying going on. One of my points of confusion, between buying on positive open, this I get. Hold on now. But if it opens, buy if it opens up and buy on positive trading. The latter concept I don't get. It seems subjective. On what point do you say it's trending up and there's a positive trading? 45 minutes into the day, 3 hours. What do you look for positive trading versus a positive open? Positive trading to me is let's see if I can do this. Positive trading to me is we've had some up days. I may make this a little bit steeper. What is all our indicators telling us? Telling us we're above the T line. Stochastics is still heading up. The next day it opens and trades down. Is that a reversal? No, I'm kind of still anticipating that we're in an uptrend and that this is selling off. So on this day, it trades down here in the first 45 minutes. I may not be buying anything because everything's selling off a little bit, profit taking. Then we see the 10-minute chart start turning back up and they bring it back up. Then I might be buying. That pretty much tells me we're not changing direction. We just had some consolidation. The next day, we wake up and the pre-market futures are up 60 points. That pretty much tells me they're taking a positive. I'll buy almost immediately on that open if I see a positive open and the market's opening higher. I mean a positive open in the stock that I'm anticipate buying and the market's opening up positive. That's reason to tell me that the buying is still there. The buying is still there, meaning we're still in the uptrend that we anticipate is in progress. So I hope that's, I don't want to see if I'm ready to buy on a positive open the next day, the market's open way down here. That's not a positive open. Even though the stock that I'm looking at may be opening and moving positive, I don't necessarily have to jump in immediately until I see whether it's still going to keep moving positive in spite of the market going down or whether it's going to lollygag a little bit while the market is trading lower and then starting to head back up. So it's not a subjective. It's just kind of common sense analysis. Are we still moving up? And is the stock that I'm looking to buy opening in the right direction? So there's four quadrants. If the market is opening positive and the stock that you're looking at is opening positive, that's everything that you've analyzed should be happening, then I'll probably go in and buy immediately, meaning within the first minute, 2, 3, 4 minutes, as long as I see that they're having open positive and immediately start selling it off. The next quadrant is the market opens positive, but the stock that you're thinking about buying opens slightly negative. Well, you don't have to buy right away because you can't tell whether sellers are taking control or whether that's just initial profit taking. So an easy entry is that if it opens lower and the market's heading up, you just put a buy stop one tick above the level where it closed the previous day, because if that new day opens lower and then starts moving back up through the previous day's close, that basically tells you the bulls are still there. That's when you want to be buying. The third quadrant is that your stock opens higher, but the market is opening lower. You don't have to necessarily jump right in. You can watch to see what that stock is doing. If it's still moving steady or positive and the market's not coming back up yet, that means somebody's still buying even though the market's lower. And then the fourth quadrant is the market opens lower and your stock opens lower. You don't need to do anything. You just sit and wait to see what happens to the market and see if things get turned around. So those are just kind of four easy quadrants to use. If the market opens lower and you're looking at something that has a very strong buy chart, what did we just look at? RP, for example. Let's say RP opens up slightly stronger tomorrow and the Dow opens down another 100 points. And this opens up and doesn't really move because the market's moving down. You don't have to jump in and buy it. You can wait to see if the market stops heading down and starts back up and that stock moves up. Or on the other hand, if the market opens positive, let's say you're in an uptrend and this stock opened here and the market was trading positive, you just watched. If it starts coming back up through, it's creating another green candle. Tells you the bulls are still there. The kicker signal, Dennis, let's see, we found one, what was it, cocoa? No, coffee. No, sugar. Kicker signal. This is a bearish kicker signal. It's where you're in a trend. The last day over here, they opened it here and closed it here. That created the green candle. The next day, look where they opened it. They gapped all the way down below the previous day's close. I'm sorry, the previous day's open, and went this way. So they went from going this way to kicking it back below the previous day's open and going the opposite direction. That tells you there's been a vast change of investor sentiment. This is your strongest, highest probability, most powerful reversal signal is the kicker signal. SGBI, for example. SBGI. Down here. Opened here, closed down here. Opened at the same level it opened the previous day and went this direction. That's a kicker signal. That tells you there's going to be more upside. Bigger font, okay. The moving averages that we're using. Right on here, the blue line is the 50-day moving average. The gray is the 20. Those are simple moving averages, and somewhere on here there's a 200, which is the big red line. Those are simple moving averages, and those we use because that's where all the major money managers in the world use those to make their decisions. The benefit we have with candlestick signals is we can see exactly what's going on at those moving averages immediately. We don't need 3 or 4 days of confirmation. We don't need a 15% move in the opposite direction to get confirmation. We can see the very next day what the signal is telling us. Okay, let's see. Where was I? Oh, we're still going through some of these. XXIA. This one, just on a relative strength basis, closed flat after opening lower, and a market that was selling off. This fry pan bottom is still in effect. And some of the ones that we owned or had been recommending over the last few days, Infa was one. It had backed off on a 200-point day, but it closed right here as a doji, right on the T-line. This makes it fairly simple. First, we had a strong buy. Then we had some consolidation. Then we had a market that was just falling out of bed, and this stock opened and closed right at the same level. This kind of is good strength if they open this positive tomorrow. Now, if they open it negative, that tells us they're going to move it in the direction of how they open it after a doji, which means they're opening it below the T-line, which means they're probably going in this direction. That tells you want to close out the position immediately. Now, again, knowing these type of simple rules from the candlestick signals makes it very easy. It gets you out of the position immediately. It eliminates that emotional decision-making process. Saying, oh, man, this had a strong buy signal. Should I wait it out, see if it can turn back up? Oh, it's trading lower. Should I sell here? Oh, I should have sold where it opened. Maybe I should hold here in case they bring it. You don't have all that decision-making questions going on. If it opens lower, the rule of thumb is if they're going to move it in the direction how they open it, you close it out immediately. That's the advantage. That's one of the major advantages we have using candlestick analysis is because we know what the results of specific pattern setups are going to be, and it allows us to make decisions immediately. IRBT, another one that notice the pullback. Market has dropped off, 500 points over the last couple of days. This one has just moved basically sideways. You want to keep an eye on this one. We're still coming out of a fry pan bottom. We've consolidated, but we've consolidated sideways. That tells us that we're probably heading higher as soon as we see the market stop selling anyways. Krispy Kreme, Question on Bollinger Bands. Bollinger Bands work. We've had John Bollinger on here a couple times, but he'll be one of the first ones to say that you don't use Bollinger Bands for decision making of when to get in and when to get out. It basically tells you whether you're out of a range, if you're up too high, where at that point, if you see a candlestick sell signal out above the Bollinger Bands, it's probably time to take profits. Now, the T-line, the 8 exponential moving average, to me is a much more effective trend analysis tool than anything out there. So that's not to say that you can't use Bollinger Bands. The way I use candlesticks is, number one, the signals and the patterns are my top priority. Now I can apply anything else I want to add the credibility of whether those signals are working or not. Okay, let me zip through here because they're probably eating my pizza out there. Whoops. YRCW held up relatively well, but this has a long-legged doji in the overbought condition. Makes it very simple. They're going to move it in the direction of how they open it tomorrow. And Ruckus was acting well because it was just coming off of this doji sandwich. And what do we know about a doji sandwich? That the probabilities are pretty strong. They're going to move it higher after the doji sandwich. And if they did a doji sandwich, what type of pattern was this confirming? Kind of a scoop pattern. So here's one that has high probabilities of moving higher, even though the market might be soggy. No, I had my milkshake for breakfast. Is it Weight Watchers? What am I on? Can't remember. Weight Watchers. All right, so stocks that have good buy signals can easily turn into stocks that have good sell signals. For example, the other day, we were recommending UNXL if it opened positive, coming up through the T-line after the Morningstar signal. That looked all fine and dandy until they brought it right back down and negated this for two reasons. Did a bearish engulfing signal, even though you're not in the overbought area, but it still did a bearish engulfing signal, number one. And number two, it closed back below the T-line. Just the simple fact that they closed back below the T-line puts the probabilities extremely strong in your favor that the downside is still in progress. That's right. They are supposed to leave some beer. My Slim Fast beer. So this one now still has more downside. As you can see, we are in a downtrending mode on this one. Ooh. Okay. Okay. Let me do a couple more, and then I'm supposed to be entertaining. Let's see, AKAM. Another one that has failed the T-line, starting to go lower. This one, suspect it's going down to the 200-day moving average. Notice the indecision of trying to climb back up, but it couldn't get back up above the T-line. And NXST held up reasonably well, but it did a doji right here near the lower end of yesterday's trading range. This one only has one thing to do tomorrow to stay in it. It has to open positive. If it opens lower, we know at least they're going to come back down to the T-line. Again, that just is some simple analysis. Now, some of the stocks that really got whacked, the gold stocks. Notice how AUY was rolling over, now gapped down. We recommended shorting AEM today. We still shorted it even though it gapped down because this tells us they weren't holding on to this level anymore. They were going much lower. And notice how this downtrend started. A kicker signal right there at the 50-day moving average with stochastics heading in this direction. That was pretty good probabilities that things were heading much lower. ARO, another nice short. Now, I'm going to zip through these because if you don't like shorting stocks, there's a lot of the short funds that you can be buying that are doing the same bullish patterns as the bearish patterns are doing. The slow curve, gap up. That's the TZZ. That's double gold short. And ERY. Same scenario. So there's a lot of good short funds that you can get into where you can buy. A lot of people can't short in their IRA accounts, but you can buy the short funds. ZSL, that slow curve pop-up. That tells you there's going to be more upside. Okay, I hate to cut this short, but I'm having lights flash and people telling me I need to be upstairs. So sorry to cut this short, but again, when you're entering and exiting trades, do it with common sense, which is basically what the candlestick signals are telling us is if the market's opening higher, you want to see your stock prices opening higher. If the market's opening way down, you're not going to be buying stocks when everybody's bailing out of stuff. So with that, everybody have a good evening, and we'll see you all in the morning. Talk to you then.